James Altucher is out with new stock picks and he claims he found AI stocks that could create new millionaires. I reveal them in this video for free so you don't have to buy his newsletter. There's multiple stocks to uncover and we're just going to jump into things. All these stocks have to do with AI build out and here's the clues for the first one. First, you'll get the AI power play. This tiny stock is solving AI's biggest problem, power. Remember those 11,000 projects stuck waiting for a power grid connection? This company found a way around the bottleneck. They're plugging big tech in right now. That's why it's already exploded 300% this year. The stock being pitched here is Bloom Energy, ticker BE. Bloom Energy Corporation, based in San Jose, is positioning itself at the center of the clean energy transition with its solid oxide fuel cell technology. Its core systems, the Bloom Energy Server for on-site power generation and the Bloom Electrolyzer for hydrogen production, convert natural gas, biogas, and hydrogen into electricity through efficient electrochemical processes, and can even operate with zero carbon emissions when powered by green hydrogen. Since going public in 2018, Bloom has expanded its reach across multiple industries, supplying energy solutions to data centers and AI infrastructure providers, utilities and telecom operators, as well as sectors like healthcare, retail, and agriculture through both direct deployments and channel partners. Bloom Energy's investment appeal centers on explosive growth, competitive technology, and deepening strategic partnerships. The stock has surged more than 1,000% amid an industry-wide boom driven by soaring power needs from AI data centers, and the company's revenue climbed 57% year-over-year in Q3 2025, reaching $519 million. A landmark $5 billion partnership with Brookfield further reinforces Bloom's role in powering global AI factory infrastructure. Its solid oxide technology offers key advantages, delivering superior electrical efficiency compared to traditional gas turbines through advanced electrochemical processes. Bloom's systems also provide fuel flexibility, running on natural gas, biogas, or hydrogen, allowing the platform to evolve with the broader clean energy transition. By leveraging low-cost ceramics instead of precious metals, Bloom reduces material costs without sacrificing performance. Partnerships with major players such as Oracle, AEP, and Equinix validate both the technology and Bloom's expanding position in mission-critical power markets. Bloom Energy's rapid rise comes with several important risk factors investors should consider. The company faces potential capacity constraints, as its current production footprint may struggle to keep pace with the explosive short-term demand created by the AI data center boom. Also, cost pressures are another concern, with tariffs posing a threat to margins and Bloom's competitive position in global markets. Analysts have also raised questions about financial transparency following the removal of certain disclosure items and the unexpected departure of the CFO in May 2025. Valuation remains an issue as well, with the stock trading above many fair value estimates despite Bloom posting a $217.7 million net loss in 2024. Ultimately, while the company's positive Q3 results, including 0.15 in EPS, signal a meaningful inflection point, investors must balance Bloom's substantial growth trajectory against execution risks, competitive pressures, and the uncertainties inherent in rapidly evolving fuel cell technology markets. Bloom is currently dipping, but I'd probably wait a little more before jumping in. It's growing fast, but the valuation is nutty right now. I'm going to reveal the rest of the stocks in 15 seconds, but before I do that, I want to remind you to sign up for my free report on the top 10 stocks to buy and hold forever. This report comes with no gimmicks, no get-rich-quick nonsense, just solid long-term investments you can actually feel confident owning. Click the link in the description to get your copy right now. Here's the clues for the next stock. Big tech needs this company's patent-protected technology, something I call quantum transmission, to move data coast to coast at lightning-fast speeds. That's not a ton of clues, and my best guess here is Coherent Corp, ticker COHR. Coherent Corp is a global leader in engineered materials, optoelectronic components, and laser systems that power innovation across industrial, communications, electronics, and instrumentation markets. Founded in 1971 and rebranded from II-VI Incorporated in September 2022, the company is headquartered in Saxonburg, Pennsylvania. Coherent holds roughly a 25% share in the optical communications market, supplying advanced transceivers essential for modern data centers and AI infrastructure. Beyond networking, the company produces high-performance engineered materials for a wide range of industrial applications, along with cutting-edge laser systems used in precision manufacturing, solidifying its position as a critical player in multiple high-growth technology sectors. Coherent's investment strengths center on its accelerating momentum in AI-driven markets and its improving financial performance. The company delivered FY 2025 revenue of $5.81 billion, a record result representing 23% year-over-year growth, followed by Q1 FY 2026 revenue of $1.58 billion, up another 17% year-over-year. Profitability has strengthened as well, with Q1 GAAP EPS rising to 1.19. Coherent invests more than $500 million annually in R&D, reinforcing its technological leadership and enabling continued innovation across its portfolio. Demand from AI and data center customers remains a major tailwind, with the company targeting double-digit revenue growth in these high-priority segments. Its leadership in advanced 1.6 terahertz transceivers supports a durable competitive edge, and Wall Street reflects this optimism. 14 analysts currently rate the stock a strong buy. Combined with disciplined balance sheet management, including a $400 million debt reduction in Q1 fiscal year 2026, Coherent is positioned as a financially stronger and increasingly influential player in next-generation optical and laser technology markets. Coherent faces several risk considerations that investors should monitor closely. Despite record revenue, the company reported a FY 2025 GAAP net loss of 52 cents per share, underscoring ongoing financial headwinds. Its debt-to-equity ratio of 59.4% highlights elevated leverage, and relatively weak interest coverage reinforces the need for continued balance sheet strengthening. Coherent is also exposed to cyclical industrial and communications markets, where downturns could pressure demand, particularly for higher-margin, custom-engineered products, and revenue remains concentrated in the networking segment. Competitive intensity is another key factor, as the rapidly evolving AI and optical communications landscape pits Coherent against both well-established incumbents and fast-moving emerging players. The company must also keep pace with rapid technology cycles, requiring sustained R&D investment to protect its leadership position. Finally, global supply chain complexity and component availability create potential operational challenges. Overall, investors should weigh Coherent's high-growth AI opportunities against its leverage profile and path toward sustained profitability, while monitoring upcoming quarters for progress in debt reduction and margin expansion. Coherent is a good stock to buy at the moment, I believe. The valuation isn't out of control, it's growing fast and integral in data center build-out. Here's the clues for the last stock. You'll also get the $9 trillion agent takeover. This stock is targeting a $9 trillion disruption in the financial services sector by using agent technology. They're scaling fast with millions of customers, and they're cash flow positive. At first I thought this was UiPath, but because this company seems to focus on financial companies, I think it's likely Lemonade Inc. Lemonade is a technology-driven insurance company disrupting traditional models through its AI-powered digital-first approach. Founded in 2015, Lemonade uses a native AI platform where machine learning replaces traditional brokers, enabling instant quotes, fast underwriting, and near-instant claims processing. Its mobile-centric design delivers a seamless customer experience from policy purchase to filing claims, setting it apart from legacy insurers. As a certified B Corp, Lemonade also operates a unique give-back program that donates unused premiums to customer-selected nonprofits. The company currently serves markets across the United States and Europe. Lemonade continues to show strong growth momentum, with Q3 2025 revenue increasing year over year at a pace that far exceeds industry averages. Its customer base expanded 24% year over year, reflecting rising market traction and accelerating adoption of its digital-first insurance model. In-force premium grew 30% year over year, highlighting the company's ability to scale its policy portfolio effectively. Operational excellence remains a cornerstone of its strategy, as AI-driven efficiencies reduce costs while enabling instant claims and a superior customer experience. Profitability trends are also improving, with gross margins climbing into the 40s and adjusted gross profit surging 110% year over year in Q3 2025. Lemonade has achieved 3 consecutive quarters of positive net cash flow, underscoring its increasing financial discipline and business maturity. In recognition of this momentum, the company raised its full-year 2025 revenue guidance to approximately $730 million. Lemonade carries several investment risks that investors should consider despite its rapid growth. The company's path to profitability remains uncertain, with a history of significant losses and an average annual net loss deepening by 5.7% over the past 5 years. Q3 2025 alone saw a $37.5 million loss. Valuation is another concern, as many analysts believe the stock is significantly overvalued, with fair value estimates well below current trading levels. Competitive pressure is intense, with Lemonade battling both established insurance giants like State Farm as well as agile insurtech startups targeting similar markets. Additionally, customer service remains a point of vulnerability, highlighted by more than 600 Better Business Bureau complaints over 3 years related to claim denials and service quality. Overall, while Lemonade's growth metrics are undeniably strong, investors must balance its innovation and market expansion against profitability challenges, valuation risks, and operational headwinds. This stock is a toss-up to me. Some people seem to think it's a great stock, and others think future success is already baked into the stock price. I'd probably hold off from buying currently. And before you leave, make sure to click the link in the description for my free report on the top 10 stocks to buy and hold. These are companies I think you can buy and not worry about for a decade.